Right. It was yesterday. And yesterday we made a start with good afternoon. By the way, 1 second. Good afternoon, Eva. Right. And so yesterday we made a start with the income tax. And I did mention to you, so if you look at the advanced tax income tax, we don't have much here. If you just scroll down, that's how far advanced tax, because they're expecting you to have the brought forward knowledge, right? That's one of the reasons why we always cover previous level, which is the tax in depth. We complete the tax book, and then only that we will be moving on to each chapter wise, right? So if you just look at the first bit here, in the advanced tax books, we went through the pro forma of the income tax. That's how far that we have done. And then also we have gone through the rate tables yesterday, right? And we said there are three different categories of income: non-savings, savings, and dividend income. And also we have three bands, right, which are basic rate band from 0 to 37,700, then 37,700, one towards 125, 140, going to be the high rate band, then additional rate band. For each band, we have different tax, right? For each different tax sources, we have different tax rates. Only for the savings income, we have special concessions, special savings reliefs are there that we will need to make note, right? These would be given in the exam table. And these will be given in the exam table. Is someone having issue with the connection? Right. So these will be given through the in the exam table. You will find there. So person allowances for tax year 25-26 is your exam, right? FA 25 is what you're gonna learn. Person allowance is 12,570, right? And then savings income. So they have given us, for the basic rate 1,500 and 0. We're gonna learn this today, right? And then the dividends 500. We will be learning this today as well. I'm just showing you what we have covered, right? And so once we cover the first chapter of the tax book, automatically it get covered in depth of the advanced tax books chapter 2, right? Let's switch back. Now let's get to the advanced taxation, second chapter, income tax. Right. We made a start of the questions, but then remember yesterday when we started from the 2 income tax computations, right? Because why? Sometimes it's easy to do computations first, and then gradually you take those specific rules. If you have any specific rules that we need to learn, we just need to spread them across. So it's easy for our brain to absorb, right? Rather than trying to cover everything together, right? Before we continue with what we started on income tax computations, let's look at the first rules regarding income tax, right? And the simplest rules that we need to remember. And if you are a UK resident person, if the individual, right, if the tax individual is a UK resident person, let me see if this can make it big, right? If the tax resident is if a tax individual taxpayer is a UK resident person, then his worldwide income would be subject to UK taxation, right? Whether income he gonna earn from UK or income that he earned from overseas, everything would be subject to UK income tax, right? Same would apply to CGT, right? CGT we're gonna learn later. So a taxpayer's resident has important consequences in establishing the tax treatment of their UK and overseas income and capital gains. Then generally an individual who is a UK resident is taxed on his worldwide income, right? That's the starting point. You need to be very clear, because every questions in the tax, when they start, they give you details, background of the details of the taxpayer. So they would clearly tell us whether the person is a resident or a non-resident, or sometimes we may have to find out whether the person is resident or a non-resident, right? By the way, I haven't given access to the tax folder yet, right? For the ATX folder, I just need to update the folder. Once it is done, then the recent videos will be uploaded probably later today. I normally don't have lessons on the first week. I said to you, I can even see myself being exhausted, right? But I'm trying to do the first week, and then by tomorrow, Tuesday, you should all have access. I haven't given access to you anyone yet, right? On the advanced tax folders, right? Right, that's the starting point. If a person is resident, his worldwide income is subject to UK tax, right? Then the person is non-UK resident, then only his UK income would be subject to UK tax. Only his UK income would be subject to UK tax. His overseas income wouldn't be taxed according to the UK tax regime, right? Whereas a non-resident person is liable only to his UK tax, not his overseas tax. This is the very starting point. But sometimes determining whether someone is a resident or a non-resident, it won't be that straightforward, right? For that purpose, we do have some statutory test, right? And we do have some statutory test to run through. So when you run these tests through, we have 3 tests to run through. We do them in particular order. The first test would be to see whether someone is automatically overseas resident person, which is known as automatic overseas test, right? So why we need these tests? To determine whether individual is a non-resident person or a resident person. The first test would automatically identify the person as overseas person. If he's overseas person, automatically he wouldn't be a UK resident person, right? That's the idea that we need to have, right? So the operations of the test, they're given in the flowchart. We come to the flowchart at the end, right? Let's now look at the first test now. I'm going to do only one test today. Then we're going to move on with the computations. Next time when we're going to come, we're going to see the first test and we're going to move on to the second test. Likewise, we will do them repeatedly, right? Remember I said to you, for tax, you do them repeatedly. That's where you would see the success, right? Because you have many different, at least 5 different tax regimes. Each has different way of approaches, techniques, right? So when you do them again and again, that's where that you will get better at this paper, right? Right, let's look at the first rule. The first rule says, right, the automatic overseas test must be considered first, right? So this is the very first test, automatic overseas test. When you're going to apply these tests to see whether someone is liable to UK tax or not in terms of residency, this is what you need to apply first. Now, in terms of, one more that you will see when you're going to learn IHT, the permanent home, which would be determined based on domicile status of an individual. But the way that it has been presented in the FA25 is different to what you have in FA20. This is I'm repeatedly telling you, you must not use any old textbook, right? Online stuff is not good enough for tax papers. So you must use the, FA25 books, which I showed you the last week, right? I'll try. If I can get a PDF versions, I will share it. Otherwise, it's always better, to have the book, right? Let's see. Now, we're going to look at the first test now, right? First test is what we have to do this test first. We need to apply the overseas test first. What does the overseas test would say? An individual will automatically not be a UK resident for the whole of the tax year if he meets these conditions, right? Any of these conditions, see, all, right? Any of these conditions. Then I will also show you the table. It makes much easier for you to understand if I show you the table at the same time, right? So if any of these conditions satisfies, the individual, the taxpayer that you are assessing, would automatically not be a UK resident person. That means he's a non-resident person. So he has to pay a tax only for his UK income in UK. Overseas income would not be taxed, right? The first rule here, he spends less than 16 days in the UK during the tax year. That's the first one. So anyone, say for example, you are living in UK, you short period, you only lived less than 16 days in the current tax period, then you would not be taxed. You would be considered to be a automatic overseas person. So you're not automatically, you're a non-UK residence person. So your overseas income would not be taxed in UK. Only a UK income would be taxed in UK. Then on the next is where he lived a little bit more than 16 days, but less than 46 days, right? First one we said anyone who lived in UK in the current tax year less than 16 days, automatically non-resident person. He's an automatic overseas person. Then the next we are saying a little bit more than 16. Yes, he lived more than 16 days, but lived less than 46 days, right? So when you have less than 46 days, he spent less than 46 days in the UK in a tax year. And when someone goes over 16 and less than 46 days, we look at his previous residency, right? So if you can find out for the last 3 previous tax years, if he is not a UK resident person, then automatically is a non-resident person for the UK. First is what? Less than 16 days, he would be a non-resident person in the tax year. Second one, he living less than 46 days. But when you check his previous residency for the past 3 years, he wasn't a UK resident person. Therefore, in the current period also, he would not be a UK resident person. Then the last one, where someone worked full-time overseas throughout the tax year, but they came back and they lived in UK or spent time in UK only less than 91 days during the tax year. So in that case also, they would be automatically overseas persons. That means they're not UK residence persons. So these are the 3 conditions we need to remember. That's the first test, right? If I now look at show you the flow chart to determine, these are statutory test of residence. So to determine whether someone is UK resident or not, the first we would start from, does the individual satisfy any of the automatic overseas tests? That's the first step that we've gone through. What does it mean? If he live less than 16 days, he wouldn't be automatically overseas person. If he less than 16 days, yes, then he's an automatically non-resident, right? Then if he lives more than 46, but more than 16, less than 46, but previous 3 years also is not a resident, then automatically is a non-resident person. He worked full-time overseas and the current period, tax year, only lived less than 91 days, it would be automatically an overseas person. Now let's try this question and then we'll come back, right? Can you try activity 1? I hope you can see the activity 1. Is it readable? Activity 1? Can you guys read it? Clearly see the activity 1? Yes. Oh, no, no problem. That's okay. No problem, Eva. It's fine. Can you try activity 1 to see whether what your answers are, and then we'll... Thank you. So the first question they're asking us, in one tax year, right, Sally spent 15 days in the UK, right? So what would be this? If she spent only 15 days in the UK, and what can you say about a UK residency? Would Sally be taxed in the UK? Would be a UK tax resident person? Sally is UK, not a UK resident person. No, very good. So you all understood the first conditions, right? She lived less than 16 days. Excellent, right? And you can see here, right? She lived less than 16 days. Right? That the first one automatically applies. So because she left than 16 days, she passes the automatic overseas test. Therefore, she is automatically overseas person, automatically UK non-resident person. So impact is what? Overseas income would be the one that would not be subject to UK tax. Only the UK income would need to be taxed. Now, at the same time, I'll explain this table. This is the table that you would find in the exam paper, right? This will be given to you in the exam table. And you see now, the first 2 are given here. The first 2 are given here on this table. And this is an easy way to remember. You're going to see the next test, 2 extremes, right? I'll cover the 2 extremes. If someone lives less than 16 days, automatically the person is non-resident, right? You know, why we need to have these 2 columns, that's related to the third test, right? But I'm trying to explain it at least gradually now itself. So we just saw from overseas test, if someone live less than 16 days, automatically the person is non-resident. Automatically the person is non-resident, right? This 183 or more, that's the second test. If someone lives more than 183 days or more than 183 days in one tax year, a person will be automatically resident. This is how you read the table, right? See the 2 extremes first. First extreme, less than 16 days, automatically overseas person, non-resident. The last one, if you live more than 183 days, equal or more, automatically residence in the UK. That's going to be the second test, right? Now we're going to do the second test, not today, the next lesson, right? So we've done the overseas test. Now let's see what are the other tests there. We have 3 tests to go through. Second test would be automatically UK test, right? Second, once we know the person is not automatically overseas person, then the second test we apply to determine whether he's automatically UK resident. If it is not automatically UK resident, then we have a unclear situations. Under the unclear situations where that we would apply to see sufficient ties test. The sufficient ties test is where, based on the number of periods they lived, as long as they have few connections, right? And based on their connections, we would determine whether the person is a UK resident or not. Those are the 3 tests that we would do, right? We have just done one and we would be coming back to the remainder. This is the exact way that I would teach throughout, right? You're going to see when you're going to start CGT, there are more than 10 reliefs there in the CGT. That's one of the difficult area for students, right? So that need to be spread across. When you spread, you are giving more time for your brain to work, right? That much easier to learn. And also there won't be no stress towards the end because you're doing repeatedly again and again, right? But you have to be, committed and serious. That's one of the key things needed. Otherwise, it'll be a time waste, yours and mine, right? Let's move on. Right now, we started this with income tax, and we said income tax has 3 different sources: non-savings, savings, and dividend, right? And then I advise you always better to have the pro forma on the left-hand side. And I know some students do like mental maths. They do quickly. When I ask figures, they don't do any tables. They quickly give me the answers, right? So it is good. I'm not saying anyone from here, but when I taught previously tax, that experience, right? But then it is very clearly pointed out by the examiners for the tax. We've been given an approach to computations. So we have to follow the approach for computations because marking schemes are presented accordingly, right? So yes, someone can quickly arrive this number, taxable income, but then that wouldn't give you the full mark that is being allocated. They wants to see how you have done, arrive the total income, how you have arrived the net income, then how you have arrived the personal allowance. They need to see all those because marks may be given for each of them, right? So apply properly when you try questions. And also we said for the tax year, for the individuals and or even for the partnerships, and partnerships don't pay tax. Partners do pay the income tax. So the tax year 12 months for them starts from 6th of April to 5th of April. I'll give an example how to work this out yesterday. So this is how you would write them. When you write tax year 25-26. 25 would indicate the starting of 6th of April to it moves one day before the 5th of April 26. That's the 12 months we would be taxing. So why this is important? Because even for the income tax, say for example, you received a bonus, and then the bonus you received was cash bonus you received was not 5th April 26, is on the 6th April 26. Based on the date, 6th April 26 is not in the current year, it's in the next year, right? So to identify whether particular item falls within the particular tax year, to tax its key. That's why we need this 12 months period, clearly. These pro formas we have done, how the chapter gonna move later, it's gonna build further, right? So we would first start non-savings income. We know the types of non-savings income are trading income, employment income, property income, even pensions. All these would fall under non-savings income. But once you see when the chapter goes on further, you see the chapter 3 by the side where my cursor is, that would go deeper into study the employment income, the rules, the benefits, formulas related to calculating those benefits on employment income would be covered. Then we would go to property income. Then chapter 6 would cover the property income in depth. We have special rules, specific rules to learn under the property. Then I talked about pensions. Pensions is one of the areas that you need to focus on because we have specific rules on pensions as well, right? It's an area for whatever the level, that's an area that you need to focus on, right? I keep saying, learn to understand it. That's much easier rather than memorizing it. Ask questions why this is given. That's the way you need to take the subject, right? Let's move on. And also I've highlighted about these two: qualifying interest and then loss reliefs, right? And let's move on. If I just quickly show you the book from here, you see, this is advanced tax, qualifying interest. You're going to see under 3. We'll be coming back to do in depth, right? Now we made a start on yesterday on one of the questions. I said I'll be explaining them clearly. Now this would be the time to go through the 3 sources of income. We know income tax, an individual taxpayers' income would be categorized into 3 main sources or categories. And those are non-savings, savings, and dividend. Why? Because for each of them, we have different tax rates. And these, income that falls within this list has been given here. So, trading income, we have just gone through employment income, property, pensions, right? But at the same time, you just need to remember whatever the figures that we're going to record on the income tax computations table will be recorded in its gross amount, right? So if any amount which are not gross, we may have to gross it up, right? That exercise we would do. So those are examples of non-savings income. Then examples of savings incomes are bank interest, building society income. Then we have these company loan stock, right? And then we have the government loan stock. Interest, if you receive from corporate bond, interest you receive from government bond, gilt are government stock, government bond. Like corporate borrow money, government can issue bond and raise money. Those are government bond. And also national savings and investments income. All these are examples that would falls within the non-savings income. Dividend income, of course, you get because of ownership of shares. We know when you own shares, you can get 2 different types of return. One return is based on the share, the company sharing their profits through dividends, and the second one would be share appreciation, right? So dividend income, when you get, it will be taxed. So why that these are given in a separate headings? Because why not we put them together and tax once? Because tax rates are different to each of these categories. Therefore, we also tax in a proper way so that our client or our, if you're a tax accountant, you want to prepare tax in such a way so your client would pay less tax. Now, this is an important area, right? Exempt income, this get repeatedly tested. And even at the advanced tax, and think there was once they were very recently they had a questions on vouchers. This is very important for you to know. So we need first know not all the income would be taxed. Some of the income would be exempt from UK income tax, right? Some of them would be exempt from it. See, income from certain investment would be exempt from UK income tax. Exempt means you don't pay tax, 0 tax for that, right? So they are therefore useful for tax planning to minimize the tax from investments. Why? If you're a tax accountant or you're a tax consultant, you should be able to advise your client to invest in schemes that would be exempted or that would be lower tax. That's tax efficient way of investment, right? So what are the exempted? The easiest exempted to start with would be the one that I like is this. The winnings from lottery would be exempted, because I've seen in US they charge heavy money on winning from lottery. So here in UK there is no tax on winnings on lottery or winnings from premium bond prices, no tax. It will be exempt income. Then the second one would be statutory redundancy payment. We know what our redundancy payments are when you lose job at workplaces, and by legally they would have to pay a statutory redundancy payment if the employer dismisses you, right? And in that case, we may have to pay tax. In that case, the money that we receive or income that we're going to get from that would be exempt from UK tax. Then we have income that we're going to get from national savings certificates, right? National savings certificates income also would be exempted. We are talking about the income, interest income, that you have a national savings certificate. In that, if you get interest income, that will be exempted. Then scholarship would be exempted. Then of course, say like you had a damages, physical damages or personal injury, and so for personal injuries you've been given compensation, right? And that compensation that you have had in your bank account, that earning interest, that would also be exempted. Then grants given by the local authorities, right? That will be also exempted. And then we have income from investments made through individual savings accounts would also be exempted. I'll come back to the chat towards the end, right? Individual savings accounts would also be exempted. Now we have this ISA is the very common, popular way of savings, right? For tax efficient savings in UK. So we have ISA, we can have two types of ISAs. We can have cash ISA and we can have stock and shares ISA. Now I need to say this to you. You know, one of the I would not say it's difficulty, how the exam paper for advanced tax first question is, we're going to go through them. First question is 50 marker, right? So the 50 marker, they would not only have one sole topic being covered. So within that 50 marker, they can get, you know, wider range of syllabus being tested for 5 or 7 marks for that, right? So that's the importance of knowing them clearly, everything, right? So there are two types of ISAs are there. One's the cash ISA, then we have stock and shares ISA, right? And so here, what we have currently, oh, what's happened? Thank you. What happened there? Yeah, I am recording. Okay, no worries. No problems. Right. Right. So we have this individual savings account, right? And so if you look at these, how much someone could contribute to ISAs in annual subscriptions, individual savings will be 20,000 per tax year, right? That's the maximum limit. If you're up to 20,000, if you invest in ISAs, whether it is cash or stocks and shares, it will be tax exempted. But it is possible that you can withdraw the funds from a flexible ISA and reinvest them without the reinvestment using up and of any annual limit. That means, you know, say you have 15, you have 20,000, then you took 5,000, but then you put back again 5,000, right? So that means you still have be exempted that the amount that is being 20,000 as an exempted amount, because you're withdrawing it. It doesn't mean that that free space is gone, right? Once you withdraw, you can reinvest that amount to make up that limit. So dividend income and interest income received from investment held in ISA, they are exempt from income tax. And these are the, you know, this is what you need to learn carefully, because you're going to see thrown up in the questions saying individual have received dividend income, but then he was thinking to put in an ISAs, and you have to advise it. So for that, you need to have the knowledge of the ISA, right? Then they likewise gains on disposal of such investments are free from capital gain tax. You see now this is also linked to capital gain tax. So you bought some shares, and so that is through ISA investments, stocks on ISA. But when you sell those shares, when you dispose those shares, generally when you sell shares, that should trigger capital gain tax. We're going to learn later, right? But then if those shares are from ISA, then that gain also would be exempted, right? Which we would be looking in detail later. And then note that the additional rate taxpayers and then the individuals who have already used their savings income nil rate band, others people who benefit from cash ISA. We know the additional rate taxpayers who would be charged at 45% of non-savings, and savings would be at 45%. And they would benefit from investing in ISA. And also, right, and also those who have completely utilized, you know, for use their savings income nil rate, and then the other benefit, they will also benefit from the ISAs, right? Let's move on. Now person allowance is something that we covered yesterday. I explained you. When you look at person allowance, always first look at the lower threshold. Lower threshold is what? If the person's adjusted net income, ANI, if the person adjusted net income is 100,000 or less, he would be entitled to the full amount. What is the standard amount? 12,570. That's the person allowance. Everyone who's entitled to, including children, right? So they would not be taxed to that amount. Then the upper extreme is what? When the person earns equal or more than 125,140. In that case, he would not be entitled to any person allowances. But then on the, if they in between, their personal allowances need to be tapered. This is what we learn. Now let me use this opportunity to explain personal allowance and we move on with the next question, right? Let me cover this up. I think I have an Excel spreadsheet for this. Right, let me open up. I'll use a different file because this is a file I'm going to upload. I'll use a different spreadsheet, right? You know, when I start lessons, I send reminders. The reason I send reminders, I know, we always get busy. Sometimes we forget. That's the reason, right? Not to force anyone to come to lessons. Don't please, right? So you don't have to, if you're not feeling to attend lessons. The lessons are always recorded. But advice is very simple, right? And it's your social hours. So if you're attending here, you need to get it first time through. And there's no point of, otherwise you'll be wasting your time. Right. Let's look at this now. So this is what I want to tell you, right? So when we're gonna deal with person elements, right? These are the notes for person elements. We said when you're gonna deal with person elements, right? Let me make it a little bit bigger. Right, person elements, the standard person elements for the tax year 2025-26. Standard person allowance is 12,570. That's the standard person allowance every individual is entitled to, right? But this standard person allowance, I'll write like this, right? The standard person allowance would only be eligible, the person would get the full amount, the person would get the full amount if their adjusted net income, right? They would get this only if their ANI, right? ANI stands for adjusted net income. I introduced this yesterday. I will write the full formula today. Adjusted net income, right? If their adjusted net income is equal or less than the threshold amount of 100,000, right? If their adjusted net income equal to 100,000, then they would be entitled to the full to 12,570. So the second extreme, right? The next extreme is where when they have their adjusted net income, right? When their adjusted net income is greater than 125,140. If it is greater than 125, equal or greater than 125,140, right? It is equal or greater than 121,030. Their personal allowances would be zero. They would not be entitled to any personal allowance. That's what we're going to see in a minute, right? But then, and I also mentioned to you about this, someone who's going to be in between, right? That means when someone's adjusted net income going to be between 100,000, right? Is much better, right? If the adjusted net income is greater than 100,000, right? But then less than 125,140, right? 125, 140, then we have to follow certain steps. Why? The person allowance would be tapered, right? The person allowance will be revised or tapered, right? It will be revised or tapered, reduced, right? It will be tapered or revised. This is what we would do, right? And now let's see how it need to be done. Remember, I covered this yesterday, and I'm going to show you. So the first step that you would do when you do person allowances, we need to find out the excess over 100,000 pounds, because we said 100,000 is a threshold limit. Excess over 100,000 pounds, right? I'm going to apply this 125 to show you, right? Let's say this is an example, right? This is an example. In this example, the person's ANI, adjusted net income, let me say it is equal to 125,140, right? But let's try this now. Right? The person's adjusted net income is equal to 125,140, right? Now, the second step, what we need to work out here. So if you work this example, what is the excess now? Excess for this person gonna be 125,140 minus 100,000. So the excess amount is going to be how much? 25,140, right? The excess is going to be 25,140. Oh, sorry. Yeah, 25,140 is the excess. The second step says, the rule says, now let me show you this in terms of personnel. It's much easier if I just show you now. So the rule says for personal allowances, so you have highlighted in yellow, right? If an individual's adjusted net income exceeds 100,000, then the personal allowance is reduced by £1 for every £2 excess income, right? So for every 2 excess income, your personal allowance will be reduced by 1. So the easiest way that we can do this, excess we divided by 2, right? Why? Because we're going to find out how many £2 are there. If this is the excess, how many 2s are there? So by that amount, personal allowance need to be reduced. So excess divided by 2 is the easiest approach for this. So here we're going to find excess divided by 2. And sorry, right? So we're going to do this excess of excess divided by 2. So we have the excess is 25,140. 25,140 that divided by 2, right? So that would bring us the amount to, right? That would 12,570. Now this is the excess, right? Now this is by, no, this is by how much your personal allowance, right, needs to be papered or reduced, right? By this is by how much the personal allowance need to be tapered or reduced, right? We need to reduce the personal allowances by this amount. Now, what is this one? This is step 2. What is the standard personal allowances? Now, we're going to find the revised personal allowance now. So the revised personal allowance is going to be, right? Revised personal allowance is going to be, we need to have the standard personal allowance. Standard personal allowance is 12,570. From that, we will reduce the excess that we had over 2 divided by 2. That is 12,570. You know why I took this example? To prove why that we said when you have 125,000, 140 equal or more, we would be no personal loss. The reason why, if you have 125,000 equal to 125,000 of your adjusted net income, you would have an excess of 25,140. So every £2 excess, your personal allowance will be reduced by 1. That means we need to excess need to be divided by 2. So how many 2s are there? 12,570. So this is by how much your personal allowance would be tapered. So your existing current standard personal allowance is 12,570. From that personal allowance, we reduce the excess, which is 12,570 again. Therefore, revised personal allowance for this individual is going to be 0. Now, this is why we say easy. You don't have to write these in the exams, right? You just need to write one word, one sentence, where that you would say, because the adjusted net income is greater than 125,140, we wouldn't be entitled to any. Now, because we have done this, now I'm going to write the adjusted net income formula, right? Adjusted net income formula. So the adjusted net income is equal to, we would start from the net income, right? Net income minus, we would write grossed up personal pension contribution, personal, not occupational, right? Personal pension contributions. Grossed up personal pension contribution, right? And then we can have grossed up gift aid qualifying donations, right? Grossed up qualifying donations. Right. So how we going to gross this up? That's one step further we would learn. Now, yesterday I showed you about adjusted net income, right? Now I've taken one step further to show you how this adjusted net income is computed. From your net income, you need to take off gross up, gift aid, personal pensions, gross up, qualifying donations, right? Gift aid donations, qualifying donations, we would be uh, deducting them. Me writing a I miss letters, but I'll correct them when I upload, right? Right, let's move on. Now we are ready to start a question. Now let's start a question. So we have covered this part. Now we have covered the person allowances. This is covered. This is also done. Now I have a questions before we start. Now can you try these questions for me? Activity 4. And tell me what will be the apply what we have just done. See whether you're able to apply for person allowances and what will be the person allowance for this amount. Anyone has an answer for this? If the net income, thank you. If the net income is right. So we have the net income, which is 105,000, right? So just to work it quickly on this, if I just have this here. Thank you. Right. So remember, we've been asked to calculate the person allowances. That's the question, right? Been asked to calculate the person allowance for 25-26. The step one is what? We need to find out the excess over 100,000 pounds. That's the step one. We need to find out the excess over 100,000 pounds, right? Oh, yeah. So that is equal to, we have 105,000, right? And then from that, we're going to take off 100,000. So that will get equal to 5,000 there. Right, so 5,000 is the excess. The step two is what? For every £2 excess, your personal is going to reduce by £1. So we just need to find excess divided by 2, right? So that is equal to, we have 5,000 excess that need to be divided by 2. So excess divided by 2 going to be equal to 2,500. Now this is by how much your person allowance need to be reduced. Now your tapered or revised person allowance, right? Revised person allowance going to be, we know the standard person allowance is equal to 12,570. From that, we deduct 2,500 because that's how much the person allowance is going to be tapered, because this person seems to be a rich person, right? Now, if you work this out, you would get 12,570 minus 2,500. It's going to be 10,070, right? That's going to be the person's revised person allowance. Now, I just need to highlight this. Now, remember what we said. We used this example. We said person allowance is based on what figure? Based on ANI, adjusted net income. How do you calculate the adjusted net income? We need to have the net income minus grossed up personal pensions contribution, right? Grossed up personal pension contribution, right? Minus grossed up gift aid donations, right? Grossed up gift aid donations, right? And so here, in this example, we were not given any other information. We only have the net income. This is the only figure we were given in this example. So the net income is going to be how much? 105,000, right? The net income here is 105,000. 105,000. Therefore, give personal pension contribution is not given, 0. Qualifying donations are not given, 0. Therefore, the net in is adjusted net income is same as his net income, 105,000. So we took it straight, because you don't have to write everything, but we took it straight from here, because we can see there is no other information is given. There's nothing given about the personal pension contributions here, right? Personal pension, nothing was given on personal pension contributions, nothing was given on gift aid. So therefore, the net income is the same as the adjusted net income. So that was this questions. Thank you for those who have done it. Right. So that's the personal pensions. I think this is the question that we did yesterday, right? We attempted this question yesterday, illustration 1. That's the first one I did as an example. So you can try this, right? Let's move on. Now we're going to move on to computing the tax. I did explain this when we first started. These rates will be given in the exams. This will be given in the exams for non-saving savings dividend. And exam table would give us, right? Then there are two items that we need to know: tax, meaning of tax liability, and tax payable. Tax liability is what we would first calculate. You know, tax rates would be applied to taxable income, right? Taxable income is one key. Tax rates will be applied to taxable income, and that will be your tax liability. From your tax liability, and anything that need to, if previously we have already paid the any tax already paid or any deductions already available, that will be deducted to arrive at the tax payable, right? So a definition of tax liability and tax payable. Why it is important? You need to know, you know, because it's very important reading the questions. When the question asks you to calculate taxable income, we don't have to go and calculate the liability. We don't have to go and calculate the payable. If the question asks you to find only tax liability, we don't have to do the tax payable. This is why this is key, right? These are the rates. Rates will be given to us in the exams. We will be applying it. Now, when it comes to now, I'm gonna, yeah, savings is next. And right, I think we also did this question. I'm going to jump into the next, cover the savings today, right? Let's try the savings. I'm going to copy this. I'm going to explain, and then we're going to try this question, right? I saw you I just showed you, when we first started, I showed you the advanced tax first chapter. It's very brief, so that is not enough for you to recap or to get to the level that the paper needs, right? That's the reason why we always cover the taxation book first, and then we build on the advanced taxation, but then we would have enough time. Hence why I am having 2 lessons per week. Right, let's do this question. Let me explain you. Now we're going to learn how to handle savings income. That's the rules we need to know when you deal with the savings income, when you start to tax savings income, right? I'm going to explain this by step. The first one here, old terminologies are still valid if he wants to use those old book terminologies. But here they have, there is a tax rate of 0%. This is known as savings income starting rate, right? Let me write this to you by the side. So when we're going to deal with savings income, right? When you're going to start taxing the savings income, we need to always follow certain steps, right? Your first step for savings income, you need to check, these are known as the savings income starting rate, right? That's the first thing that you would check. Savings income starting rate. That means what? Here you just need to check if the savings income falls, right, within, if the savings income falls within first £5,000, right, first £5,000 of the taxable income, right? If it falls within first 5,000 of the taxable income, then what would happen? Then that the 5,000 would be taxed at 0%. Now, this is the first thing that you check when you deal with the saving income. Let me explain this now with an example. Say, for example, we have the total here, right? And we have the non-savings income here, and we have the savings income here, and we had the dividend there, right? I'm just going to put random numbers. I'm just going to put only the last line, taxable income, right? So I haven't put total net personal and taxable income, just straight into taxable income. Say the taxable income here was total 40,000, right? And the non-savings income, the first example, let me say the non-savings income was 10,000. Here we have a savings income of 15,000 and dividend income of say 5,000, right? I'm only going to explain the savings income, right? So when you try to charge the savings income for income tax, right? So you need to check. This is like this rule is like this. Imagine that this is like a pot, right? And to which that you're gonna bring the savings income, your incomes to tax, right? So this rule says, if your savings incomes falls within the first £5,000, right? If it falls within the first £5,000, oh dear, this is K, right? So this is, say like this was within your first £5,000 here, right? If it's going to fall within the first £5,000 of what? First £5,000 of your taxable income, right? If it's going to fall within the first 5,000 of your taxable income, then you would get 5,000 at completely free at zero rate, but it would make use of your basic rate band, right? So when we're going to bring them to tax, we know that we follow certain order to tax them, isn't it? We don't bring the savings income first. We bring the non-savings income first to tax. When you bring the non-savings income to tax, how much non-savings incomes are there in this example? 10,000. So 10,000 means this space is already gone. Non-savings would have taken it and it will come up to this point, right? And when the savings going to take its turns to come to this, to be taxed, savings going to only fall just above this line, right? So savings never going to be within the first 5,000. I hope you understood. So in this example, savings income would not be eligible for first 5,000 of the taxable income. So you see the person's taxable income, one by one we would charge them. Can the savings income falls to the bottom of the first 5,000? That's the. Now if I just change this example slightly different, right? So in this example, now let me say there was nothing there, zero non-savings income. Now I'll put the same kind of example. Just this is the income, taxable income that you're gonna charge, and then we're gonna see whether the savings income gonna come within the first 5,000. That's the rule for this, right? So we know we're gonna tax them in an order. So the first income that's gonna fall gonna be the non-savings income. But the non-savings income is zero. There was nothing came in through the non-savings income. But after the non-savings income, where that we brought the savings income. So the savings income was 15,000, but the first 5,000 of the savings income would falls within it, right? And then the remaining 10,000 of the savings income would be outside. So when you're going to tax them, you would say savings, right? You would say savings income starting rate, right? Savings income starting rate, you would write here the first 5,000 would be at what rate you're going to charge them? Zero rate. Now, this is how you would apply the first rule. So when you're going to deal with savings income, the first question that you would ask, you don't have to write like this. It works in your brain. You just need to ask whether the savings income can fall within the first 5,000 of your taxable income, right? So you look at your non-savings, who has to go first? Non-saving is more than 5,000. So savings never gonna get the first 5,000. Second, you check whether in this example, non-savings was zero. So you still have the space. So the savings income would come and take that space. So your first 5,000 savings would be at zero. Then the remaining savings income that you had, how much is the remaining? Out of the 15,000, you take off 5,000. The remaining savings income would be taxed at the appropriate rate, right? If it is in the basic rate band, we would be charging them at 20%. Remaining would be charged at this. This is how the first would work, right? This is known as savings nil rate band. Now let's read this and then I'll cover the next one before we take the example. Now let's read, see whether it makes sense. So there is a tax rate of 0% for savings income up to £5,000, which is known as the savings income starting rate limit, right? This is called the savings income starting rate, the first 5,000. Savings income starting rate only applies where the savings income falls, see, within the first 5,000 of taxable income. For us to get this, non-saving income has to be less than 5,000 or has to be zero. Otherwise, we would not be eligible for this, right? Remember that income tax is charged first on the non-savings income. So in most cases, an individual's non-savings income would exceed the savings starting rate. Therefore, the savings income starting rate would not be available for savings income, generally, for most of them. So the savings income starting rate counts towards the basic. What does it mean? What this sentence mean? Can anyone tell me what does it mean? Have a read on this. See what does it mean? What does it mean when they say savings income rate counts towards the basic rate of 37,000? Any idea? Thank you. Let's see. Right. Now, the way that it works, right? The way it works is this. Say we said we have basic rate band, right? And thank you. We have the basic rate band. No. Right? We have the basic rate band. How much is the basic rate band? 37,700. Right? Let's try this. Let's try this example first, right? And then we don't have any non-savings income. Now we go have only savings. So even though it was taxed at 0%, even though it is taxed at 0%, we need to place them in the income tax computations table and then put 0. What is the difference when you have it here and when you don't have it here? When you don't have it here and you're gonna bring more, another 5,000 to within basic rate band. So you can't take those two advantages at the same time. Savings says nil rate band is only given 0% of tax. It is not tax exempt, right? It is a taxable income. It is not tax exempt. It is taxable income, but at 0 rate. So this would be the savings starting rate. You would write here savings starting rate. That's the savings starting rate. Then the remainder savings, you would have it here. How much we still have? 37,700, 5,000 gone. You have 32,000. You still have time to bring the next one. Next one would be 10,000. Savings income would be charged at 20%. Then thereafter, you still have space to bring the dividend income. We know we're going to see it. Dividend income would first have dividend allowance. That would be 500. We're going to learn them, just covering them now itself, right? So it is a 0 rate. Then the remaining dividend would also be part of this. And that's going to remaining dividend going to be from 5,000, you take off 500. Remaining dividends is going to be 4,500. That will be charged at the dividend basic dividend rate, right? This is how you would bring them. So the first rule, this is what does it mean, right? So when they say the savings income counts towards the basic rate limit, that means it would fill that space. Even though it was 0 rate, the 5,000 space would be taken out. And suppose if the individual has more than 37,000, then that remainder would fall into the high rate band, right? So you need to write on your income tax computation as well, but it will be at 0 rate, right? Thank you. Right, let's move one step further now. We have done this. Now we're going to learn the next bit. These are the two things you need to know when it comes to savings income, right? Right. The next one, the first, when you deal with savings income, this is the first test that you would ask. Savings income starting rate. That's the first one. Then the second one, the second one you would do when you do with the savings income, we have, see here, we do have some reliefs, which is known as the savings nil rate band, right? I'll show you here. And then I also write the old word because old term we used to use for this, but because some textbook still has it, right? So this is known as savings. Now the new term we use for this would be savings nil rate. Right, that's the new term that we are using, savings nil rate. But this is also known as the personal savings per PSA, personal savings allowance, right? Personal savings allowance, right? Which is known as PSA. This also would be known as PS, personal savings allowance, PSA, right? Right. So now, in order to deal with them, right, there are three scenarios we need to consider. Three scenarios we need to consider. The first scenario is where if the individuals carefully observe what we are checking these on, we are not checking these on savings income. We are checking these on individuals' taxable income, right? If the taxable income is within basic rate band, if the individual's taxable income is within basic rate band, they would get £1,000 at 0 rate. These are not, I think this is also given in the exam table, right? 1,000 at 0 rate. So the second one, if the individual's income, right, taxable income, we are talking about taxable income, total taxable income, is within the high rate band, then he would get £500 at 0 rate. So these are still taxable, but 0 rate. Taxable is 0 rate. So it would take off the basic rate band space. It would take off the space of the basic rate band. Then the last scenario is where if the individual's taxable income, right? If the individual's taxable income is at the additional rate band, then 0, he would not be entitled to anything at all. Now, these are the two things you need to consider when you deal with savings income, right? You need to first check whether it's going to fall within the basic rate band, within the first 5,000, and then you need to check the savings nil rate band or the personal savings allowances. If it is within basic rate band, taxable income 1,000. If it is within the high rate band, we would have 500. If it is zero taxable income, if it is additional rate band, then we would not get anything, right? Let me quickly show these questions and we'll stop afterwards, right? Let's let's try this question. Sorry, I'm losing my voice. Let's look at this question. Let me copy this and then you would try first, then I will explain quickly. You try first whether you're able to get this through for me. Right. So here's a question for you to start quickly. And let's see whether you're able to do this for me, please. This is the question for you, illustration 3, right? I'll give you around, now it's 34. I'll give you around 3 minutes. See whether you are able to do this for me. And then I'll explain quickly as possible. Right, anyone quickly? Let's start. And we can try. So when you do an income tax computations table, and first you have the non-savings income, right? You have non-savings income and then you have savings income here, right? SI stands for savings income. There is no dividend. So I will have the total column here on the right-hand side, right? Or on the left-hand side, I'll have the total column. So I'm going to first record the, thank you. I'm going to first record the trading income 15,175, right? Trading income, narrative, trading income. Trading income was it 15,170, which is a non-savings income. You record it. You also need to record it on the total column, 15,170. Then the next we have bank interest. Bank interest is a next one is the bank interest. Bank interest is a savings income, 8,000. I've done them. I also need to record it on the total. Once it is done, you know the first step afterwards. We need to find these two are the total income. These two are the total income. So if you add these two, and those are the total income of this individual, and that will be the total income of this individual. So from the total income, I'm writing the pro forma, and we know there can be qualifying. There can be qualifying interest relief, right? There can be qualifying interest relief, right? Right, qualifying interest relief, and also we can have trade loss relief. These are the relief you would learn later, right? There is nothing there. So from the total income, we would arrive at the net income because nothing to be deductible here. So we arrive at the net income. So net income is going to be the same as the total income. So it's going to be the same as the total income. So we arrive at the net income there. That's also done. Then what we need to do, we need to find the person elements. When you need to decide the person elements, right? Easy to look at the total income. This is your total income. Yeah, total net income is well below 100,000. So we don't have to do any other work. We know if the adjusted net income, if your adjusted net income is less than 100,000, and the person will be entitled to the full amount. What is the full amount? 12,570, right? So he would be entitled to 12,570. Let me see. Thank you. Great, right? Is you will be entitled to 12,570. The full amount will be relieved from the first available because we would relieve them from the source that has the highest income tax. So the highest income tax from here is the non-savings income. So we're going to relieve them against the non-savings income. And once you relieve them, we would arrive at the taxable income. Right? We would arrive at the taxable income. Right. So taxable income is what? Your net income minus your personal allowance. So your net income minus your personal allowance, your taxable income of 10,060. That's the taxable income that we had. We have got the taxable income now. Now we are ready to start the tax computations. Now I'm going to start my income tax computation. Right? Under my income tax computation, what would be the first source of income? You know, the easiest way to work this out, you always check the taxable total income. This is the key figure, right? The taxable total income is only 10,600. Because it's only 10,600, everything, all your computations going to be within basic rate band. We know basic rate band is 37,700. So we don't have to worry about writing the basic rate band. Everything going to be within the basic rate band. So we're going to, when you tax, you bring your non-savings income. That's the first slice of the income tax we would charge them, right? So why? Because it has the highest rate. It is best to charge them when they are within the basic rate, and that's the reason for this. Because when they are within the basic rate band, it's better to charge the non-savings income first. So we would bring the non-savings income at basic rate band. How much they have? They have 2,600 non-savings income. And by how much we're going to tax them? We're going to tax them at 20%, because non-savings income, within basic rate band, tax is 20%. That's done. Always is best to write them and do the computations later. Non-savings income is done, fully done. So I can move on to the savings. Now, when I move on to the savings, remember, I gave you two steps. First, you need to ask yourself whether it will falls within the first 5,000 of your taxable income. We would ask that questions, right? So if this was your savings, if this was your income tax pool, right? If this was your income tax um, jar pot that you're gonna tax, and if this was 5,000, you bring your non-savings income first. Non-savings income would go, but it wouldn't fill the full part, and only 2,600 would be taken off. The remainder is still there. So there is room for the savings income to fall within this part. Agree? How much we have still left? Out of the 5,000, right? Out of the starting 5,000, and only 2,600 has been taken by the non-savings income. So the remainder, still 2,400 still there for the savings income to come and take it as part of the first 5,000. So even though the savings, we have 8,000 there, for the 2,400 will be charged at zero because it falls within the first 5,000 of your taxable income, right? So here we would write here savings income nil rate band, savings income start rate, savings income start rate. And it is not 5,000 fully available because 2,600 is gone. We only have remaining 2,400. That 2,400 will be charged at zero rate. It has to fill this space, charged at zero rate, right? And now the remainder, how much have we done the savings fully? No, we still have some savings to charge. And before you bring this second, you may think, okay, I'm going to charge the remaining savings as 20%. No. Now, we know once you've done the first test, we check the first 5,000. Then the second test is what? We said you need to check for these three allowances. You remember these three. You've done this first test now. Now you're checking this one. You need to check the savings nil rate band to see whether we have any other special allowances, right? If it's within basic rate band, we get £1,000 as zero. If it is higher rate band, we get £500. Additional, we would not get anything. So we know when you look at this, when you look at your work, and so we are not looking at the savings income. We are not looking at the savings income total. We are looking at the taxable income total. And when you look at the taxable income total, it is 10,000. Total taxable income is 10,600. So everything within basic rate band. Because everything is within basic rate band, we have £1,000 available, right? And this is known as the savings nil rate, right? Or PSA, right? savings nil rate or personal savings allowance, £1,000 we are available at 0 rate. That's it. And thereafter we can bring the remaining savings income at the basic rate band. How much is the remaining savings income? Remaining savings income gonna be, the total savings income we had was £8,000 here. From that, we already taxed 2,400 for 0 rate. That was a starting rate. Then we also had £1,000 at 0 rate. So the remainder is what we have. That means we have 8,000 minus 2,400 minus 1,000. We have 4,600. Now this would be taxed at the basic rate band, savings income 20%. Now that's how far that we need to work these out. Once I'll come back to the chat in a minute, once it is done and your income tax computation, right? And then you would fill these up quickly because those are 0 rate. 1 second. And then these are 0 rate. And then this is going to be 2006. So I think I got a slot. 2,600 at 0.20. And this is going to be 4,600 at 0.20. And that's it. And then this is your income tax, which is liable. Income tax liability, the total of these would be the income tax. This is your income tax liability. So in this questions, what we learned to apply the savings nil rate band, right? This is what we learned, the 2 savings rate. Let me see. Thank you. Yes, that's why, it's always best to go step by step, right? Have a sort of a practice. Why? Because you always remember, that's why I wrote as step 1, step 2. Because when it comes to savings, you need to go, like a sort of a mode to these steps to follow. So regardless of whatever the questions, you ask first whether it is within the savings starting rate. That's the first question. Then number 2, you check the savings personal allowances. These 2 need to be checked one by one, right? Every time savings income, these 2 steps need to be followed. You would see that I will be rewriting it every time again and again so that you get used to it, right? Now, once it is done, I'm going to stop. Once it is done, now we have one more to do. And I can ask you to, if you don't mind, I'll give you homework for you. And if you can try illustration 4, and I will be uploading. I know some of you don't have the books, so I will upload the spreadsheets on Teams, on the Moodle page. So illustration 4 and illustration 5. So we can speed up, right? Illustration 4, illustration 5, and then next one is dividend. So if you can try as an homework for illustration 4 and illustration 5, then we will be able to finish this chapter next week, which is dividend analysis, right? And let's see if you have any question. I mean, yes, you writing step by step would definitely always help you, right? And that's always help when you write step by step. Then even though you do a silly mistakes, then it allows you to have at least some marks for, because unless it is an MCQ, tax level, yes, there are MCQ questions there. ATX level, there are no MCQ questions. You have to explain step by step, right? Good, guys. I think I went more than what I said, and I'm more than 1.5 an hour. So we are getting towards full 1.5 hours. Next week onwards, the lessons are 1.5 hours on Saturday and Sunday. I think during this month of March, I would not be able to do 1 week. I think it's on somewhere on the 20th, 21st, because I have a university open day on that date. Always be on a Saturday, a long day from 9:30 to 5:30, right? So by the time I come home, it will be days gone. Right, so that's the only day that on that week lessons I will schedule to have on a weekday evening, but I will give you enough time, right? Okay, thank you guys, and thank you for attending class, and please do revise continuously, and then I'll see you next week, right? Thank you. I'll upload the video and you will have access later today, right? You guys take care. You're welcome. Enjoy the day. I got 2 more lessons after this. Take care. Bye-bye.